Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita. Let's quickly look at what markets are up to, and we're just going to have a quick, sharp conversation with Samir Arora on this day, 1st January 2026. Great day to have that conversation, set the context for the rest of the year. But very quickly, firstly, on to the Nifty. Absolutely flat as we speak. We've given up some of the gains that we had clocked in today morning. In fact, some of the gain, it's fairly range bound as well in terms of the markets. Just 80-point band that we're trading in. So that's the other piece that's playing out today. In terms of the key losers, ITC is the big loser today. 9% lower on ITC, DRL, Bajaj Finance seeing some bit of a pullback. In terms of the gainers, there's Eternal, which is standing out. NTPC, Wipro, Bajaj Auto are just some of the names, and auto counters would likely continue to remain in focus as the day goes by. And in fact, even tomorrow, because of those auto sales numbers which are continuously trickling through. IT is the index which is standing out in terms of the sectoral indices. And even within sectors, there's plenty of movement. IT is up around 0.9%. Auto is also up around 0.9%. 0.7% higher for the Nifty Realty Index, which is sharply underperformed last year. 3% lower on FMCG, largely driven by ITC and Godfrey Phillips. Those are the two big counters which are lower. Defense is down around 0.7% thereabouts, so some pressure there. And along with it, Pharma too is down. But let's bring in Samir Arora, founder Helios Capital, to give us that perspective. Samir, great having you. First off, this is Harsh here. Samir, let me first set the context for 2026. Is it going to continue to be the kind of market we've seen over the last couple of years, where certain sectors which have underperformed may come back to the fore, or is it going to be something materially different? What can one expect?
Well, first thing is that 2 years have been quite different in the sense that 24 was a very strong year, nearly across markets. And 25 may have had this tendency where, say, auto did very well and IT did very badly. I would think it would be broader than that. And even if the market goes up a lot, the relative underperformer of IT, I think, will still stay. Auto, I'm not sure. But in general, the market would be, you feel happier in this year, I think, than we did in 25. Although at the end of the year, the overall numbers were some 5, 7, 8% up for the various benchmarks, which were not bad after 2 years of very strong performance, but looked bad because the rest of the world was having a bigger party than we were having.
Absolutely. And Samir, the real pain is being felt at the broader end, right? Certain individual stocks, and especially those within broader markets, have especially seen pain. Portfolios don't seem to reflect what the Nifty has done this year. Do you believe that will change materially as earnings starts to pick up as well in 2026 calendar year?
No, because that is what portfolio means. Portfolio means that you cannot have only in some stocks that you have, seen on YouTube an interview for 10 minutes and suddenly felt strongly about the management or something. A portfolio is designed so that some stocks may do badly and some will do well. And it is very difficult for anybody, including the biggest fund manager of the world, or the best fund managers, to have it right every year. So it will not be, because some other stocks will do very badly. We show all the time on our website that nearly every year, not nearly, every year, broadly 30% of the index stocks underperform the index itself by more than 25-30%. So, and then there's another side, which is some 30% stocks from the index beat the index by 20% per annum. I mean, not per annum, in that year. And so that will happen sometimes. So you have to sometimes see that which are the losers of, say, 25, and maybe some of them will go to the other extreme other side, but then something else would go into the bottom 20. So this difference every year, if you see between the best and the worst, I saw, I think yesterday only somebody had put out on Nifty, like Shriram is up some 70%, and their stocks down 20% from the same index. This happens all the time, every year, year after year.
Point taken. Samir, what seems to be likely this year at least is an earnings cycle uptick, which didn't play out in 2025 at all, or just has played out in maybe Q2 for a little bit. How significant is that going to be? In your opinion, can it surprise on the upside to what the consensus currently pencils in?
Well, I don't know what the consensus is, but in absolute, the numbers don't look bad. For example, I saw recently, I think HSBC or somebody had 17% growth for the stocks under their coverage. See, broadly anyway, the normal earnings growth this year, even in a bad year, might be 10, 11%. And now with the fact that there was this consumer push and very significant interest rate cuts, and in general a little bit of a cyclical recovery after 1 or 2 years of very big slowdown in consumer sector and even in some parts of infra, that to go back to 13 14 would have been anyway expected. But if you get some of these elements right in terms of the rest of the world still doing okay and we getting some break on our India US tariff, then 16 17%, which is higher than longer term average, is being expected by a few. I don't look for it like that, because my logic is that if the market is expected or the earnings are expected to be above 12, 13, 14%, it is anyway better than anything else you can do with the money. So if you tell me that the earnings growth will be 17 versus 14, my asset allocation, my bullishness on equities won't change. If you say it'll be 25%, maybe I'll have to sell some other things and buy equity. But broadly within this range, any number is acceptable because it'll be better than whatever alternative use you can have of your savings.
Right. Uh, uh, one of the possible risks to 2026 could be a US slowdown. We've spoken about this in the past. It's not come through. Samir, you expect 2026 to be that year where the US slows down, and this is despite the fact that there's one rate cut still expected, and there could be a downside risk or an upside risk, if I can call it that, to more rate cuts happening as well. So trying to get your sense,
So we
US, if
did
the biggest
benefit.
consumer slows down, is that a risk?
Well, not for us, sorry to say, because they don't allow us to export there. So how do we care for their consumer if we can't send our stuff there? So this is a relative game if that happens. If of course the US slows down a lot, which leads to a crisis kind of a situation for global growth, this, that, then everybody gets affected, even if they have no real direct relationship. For example, in 2008, Indian banks, Indian finance companies did not have any exposure to subprime crisis and to all those CDS and whatever else used to happen. But the Indian stocks fell as much or more. But if it is a slowdown where when it was growing well, we were not participating through our exports or otherwise. And so if it slows down, doesn't matter to us beyond a point. We could be big relative outperformers. And relative outperformance is a useful start, because the world has to say that, okay, you can't keep ignoring India forever. They have not been ignoring forever, but I'm saying in recent quarters they have. Therefore, I feel happy that from October 1 or from September 30th, that means the current quarter that just ended, the last quarter, India market actually did better than most other markets. It did better than US market. It did better than emerging markets in aggregate. It did better than China. The point being that the trend seems to have changed, that we are no longer underperforming. We are not catching up with whatever previous 9 months of underperformance we had as a market. But relatively speaking, if there's a US slowdown, there might be many other countries which may worry. India has less to worry because we are not able to participate in whatever growth they are having anyway.
Uh, there has been plenty of chatter around a possible inflection point where IT is concerned. You believe some point in 2026, IT will reach that inflection point, especially when it comes to growth, which has disappointed, or rather has largely been very low single digit, been in line with estimates, but still, from an investor standpoint, has disappointed?
The thing is, they have to tell us that they are growing. Why should I keep here thinking it's a point is coming? The only logic being given is that Indian mutual funds have too much money, and to try and outperform each other, they are only looking at what the other guys don't have. So let me buy that and then start praying immediately There is no other logic given if you see in all the discussions that you have and others have, except that it is under-owned and it has underperformed. Well, there are hundreds of stocks that suddenly, because for example, these days, why don't we talk about levers growth? Because it used to have its growth in those days and now it's one more regular company. So like that, it can easily happen with many subsectors, sectors, parts of the economy. We think that it is a very regular, small, 6, 8, 9% type growth. We are not currently interested in that unless you tell us that the earnings growth of the market will be 5%. Why should we, where our GDP growth in nominal terms is maybe these days only 10, but normally 12, 13%, we should be worrying about whether there'll be a turn because nobody's clarifying exactly what the longer term impact is. And also, one more thing, please note that in India, the growth is happening. If the number of employees in these uh, GCCs is, say, around 20% of the overall IT employees, and let us say, I don't know, let's say it has all happened in the last 6, 7 years, then broadly the GCCs have taken away 3, 4% growth from the IT industry per annum. So there has been growth. People are investing, people are doing, except that they are doing it on their own. Now, we don't look at anything like that. We talk about, oh, these stocks have reached longer term average multiples. Why should something be always trading at average multiple? That means there were some periods when they were trading below that average. So, what was the situation then? What was the growth outlook then? This period looks to me like a below average earning multiple environment rather than oh it's reached average. Why should either a stock be over the average, higher than average, or at average? There are many things which are below average. That is how the average itself came up. So we are currently not interested, but it doesn't take us long because we don't take 6 months to change our views. If they change, if something changes, if guidance changes, if hiring changes, we can change. What is the big deal? But right now, no interest.
Flows, Samir, how much of that component will likely play out in 2026? Do you believe FI flows will come back in a solid fashion?
So solid fashion means actually, if you look at it, last year was not very bad if you started from Feb 1 instead of Jan 1. So for the whole year, I think, I don't know now recent last few days numbers, but broadly till a few days ago, India had $17 billion of outflows. And in that, January itself was 10 billion. So from Feb 1 to December 31st or whatever, December some date, it was only a $7 billion outflow. And during that time, A, we had a war with Pakistan, and B, we had a war with US on tariffs. And after all that, and we don't have AI related stocks. And we had done, as the market had done very well in 23 and 24. And China had not done well, and Korea had not done well. And so, therefore, if 7 billion, let's say, I'm deliberately not calling it 17, now you can say, oh, I've selected it. But these are not separate months collected. It's a continuous 11-month period that I'm saying. That if some of those things change, the natural tendency of foreign investors is to buy. Now, these days, they used to buy through private equity. Sometimes they buy through public. In aggregate, they buy. Now, what happens is that because some of the private equity deals did well, investments did well, they sold. Now, that is part and parcel of the PE world, in which also, by the way, some part of it has been bought via an FI account. So it comes under an FI heading also. Basically, it was a PE investment. Maybe the last round guy, the crossover funds, the pre-IPO guys, they all buy, they are mostly FIIs rather than Ps. But when they are selling, it gets classified as FII. Broad picture is that if they are investing in every other country in the world, broadly this year, what is the logic, even one line logic, that they would not buy India? So then people come up with this theory because everything is done to justify the this thing is that they find India expensive. So if they find India expensive, you see the only things they sell is financial stocks, consumer stocks, IT stocks, which are broadly not as expensive as the stocks they buy, which are all these new age companies which get oversubscribed 100 times, mostly by foreign investors. And so it's not valuation. It is just that these things happen every now and then in markets, that one market has two, three factors combined, and therefore people do other things and then they remember. But it's not that anybody is walking away from India. For Helios Capital, just tell you one line, our FII AUM has more than doubled this year.
Yes, I'm aware of that, Samir. So therefore, if they do come in, do they again go back to their go-to sectors, financials and IT? Are those the pockets which they go to?
So I would think first, if they stop selling, that is a highlight of
Sure.
life. Then rest the
I
mutual
beg your
fund
pardon.
guys can handle. And secondly, I would think that they will first buy financials. For example, if you think that they were heavily invested in IT, they invested in Korea, Taiwan, they invested in all these places because India did not have IT. Then when they suddenly become bullish on India, they buy Indian IT as their first stop is to me less likely. But I'm saying even if they stop selling, all these things will do well, including Indian IT. It's just that these are relative choices that we are making between in our portfolio of $100 that how much has to go here or there. But broadly, if they stop selling, that would be a big starting point, which I think is happening or more or less has happened. Plus minus, because if you see from October 1 to today, I think FI flows may not even be negative, or if they're negative, it will be less than 500 million, because October itself was very positive and November half was quite positive. So you may have lost that whole thing again, but broadly you have come around near like zero type number on a net selling basis. I think financials is easy because the growth is still there and the interest rate cuts have helped the NBFCs and all. You can see all the performance of Chola and Shriram and Bajaj Finance and all that. And some of that will happen in the banks, hopefully now.
Worried, Samir, with the fact that the DI flows are so strong, and if the FI sell number starts to come off or to taper, which is what the hope is, just the DI flow number continues to remain that strong. What are the options for DIs to really invest in? Are you worried about that?
No, I'm not worried. First, let me get some gains before I worry about what I will do with the. How can you worry about strong market? We worry about weak markets. Strong markets we enjoy. We don't worry. Okay, and this idea that oh, market is strong is bad for investors, it's not like that. This is a continuum. So for example, I saw on Twitter yesterday one guy saying, oh, from December 1 people are looking at the market, they should look at it from September 24. Why? Because from September 24 it is down. Why not look at it from March 25 when it is up? This is a continuum thing. So people who will be rewarded if the market is good will give money, and then slowly they will again not do well for 6 months because the market would have gone up a lot, and then again. So it's a start and stop kind of thing. It's not a FD kind of a system that every day the market has to go up. But there is 1.5 years of relative underperformance and even absolute underperformance. I mean, it's only 5-6%. And therefore, if you see, today I read that one of the bigger fund managers of India who was warning against small cap stocks is now saying that small cap stocks are very good to buy or something like that. So all these things happen, and main thing is to lead, because nobody's investing at one point, nobody's exiting at one point. You have to look at it as a continuous this thing. We need a rally. We'll worry well into the rally, not today, please.
Samir, where railway stocks, defense counters are concerned, these are decadal themes, but at the same time, execution challenges remain in some of these pockets. How do you view that?
Broadly, we don't like decadal themes because that means for decades they have not worked. And we don't see much that suddenly something is happening. Broadly, defense as a theme is more little bit reasonable because it is in government's control to say that do not import but buy from local, because they themselves are the buyer, and they can put blacklist and this list and whatever and encourage localization. That is imaginable up to a point. But I don't like these big investment themes which says that 15 years you're developing some fighter jets and 20 years you're developing a submarine. And so even if you get those big orders, we don't relate to them because we don't know for 3 years. If you go, they'll say we are still designing, then we're taking approval. So it might happen in 20 years because it was a 20-year order to begin with, or 10-year order. From a stock market point of view, we are more interested in day to day. Day to day means year to year at least, or visibility year to year. And one more thing, if you see railways, they had this small hike of fare. Such a small hike, how that can change the investment thesis. Plus, you are doing it well before budget, which means in the budget you don't want to have even that hike. So I don't know. We don't have those stocks. Actually, we have one different stock because it's a, as we say, year-to-year stock, which is Bharat Electronics. You get small electronics orders, whether you're here, there, everywhere. You're not tied to any one big program, which is 15-year program. We don't like 15-year programs for investing. India needs, companies need, government needs beyond our imagination.
And last piece, I know you're playing consumption through some of the platform companies. What are the other ways to play consumption? And tell us how you think of it. Would you like a consumption theme to actually clock a 20% growth? Is that something that you look for? What are the filters you're using?
No. So what we say is that for new age companies with new age multiples, which have gone IPO, you better grow, not 20 would be also too less, I would think, because these companies are loss making, near about break even. But just before that, there's been discussion on new age companies, particularly these food delivery, quick commerce companies, how they are exploiting everybody. Or just look at it. In a normal order of say 500 rupees, the delivery guy gets say 40 rupees. The dream, absolute dream of all these quick commerce companies is that one day we'll make 5% margin on the sale, which means we'll make 20, 25 rupees. So in a 60, 65 rupee thing that the rider plus the company will make, 2/3 is going to the rider. And the company is left with 20 rupees. And if they make 20 rupees, their stocks will multiple because of the scale. But from each delivery, you're making 10 rupees, 5 rupees today, so you're making zero. But let us say one day you make EBITDA level 20 rupees. So 2/3 is being given to the rider. Please give me one example, one company, one sector where the share between labor and capital is 60, 65%. Even in textile, it will not happen. In IT, it does not happen. In no other sector, it happens. So this is a great sector from India's point of view, also from workers' point of view, also because of the value add, 65% is being given to the worker. You can call him or rider or whatever partner. But anyway, I think it is the number one best way to play consumption because you are not relying only on the growth of the end consumer. End consumer growth will only be 6, 8%, 9%. How much will it be? You are growing because the consumer has chosen to buy her things from this channel versus that channel. And that growth, that penetration is very, very low. It can go up 100% per annum for 5 years and still it will not be a meaningful amount. So the idea that play the end consumer growth, because end consumer does not grow as we have seen in the case of ACs and levers and all these consumer, because the end consumer growth will be 8, 9, 10%. How much more will it be? So we like these new age companies where the growth is coming because the consumer has chosen a different channel. For example, insurance growth is X. But if you're buying insurance online, everybody wants to buy online. Therefore, that growth is very high. The cash usage is very less, but now people use phone pay and Paytm and all this, so therefore their growth is higher. But that does not mean that we are expecting that the end growth of cash usage or payments or whatever has gone up. That is why we like all of these where it's a consumer play, but only on the how the consumer has chosen to use these new age these things versus the old.
You've been invested in financials for a while now. Why do you think that some of the larger cap financials lenders haven't really moved? What's the reason for that, and what's the trigger going to be?
So one reason could be that you are looking at some wrong numbers. For example, if you say large lenders have not moved, so Bajaj Finance is up, I think some 40% or something like that. Chola is up some 40, Shriram is up 70. So I think you're talking about the banks. Is that the one? Because HDFC Bank also was not bad in 25, up 12%, and ICICI is up only 4. And I think ICICI, maybe they are worried about the management, that whether Mr. Bakshi will stay or not. I hope he stays or he renews. But generally, because of the low, the interest rate cuts hit the banks more than they hit obviously the NBFCs. But actually, the financials were one of the stronger this thing in 25. They've all
Point,
moved a
Samir.
lot.
I was talking about the
Yeah,
larger banks. Wish
banks,
to
correct.
rephrase
So
that.
banks, I think,
So
yeah, basically, even here, State Bank did very well, up some 24%. I
yes,
think Axis also did well. So
yes.
broadly, they did well. It's just that ICICI, I think, got stalled or has got stalled because of that. And we are praying that Mr. Bakshi accepts our new term.
Sure. Last piece, how do you play auto? Do you play through CV, where the cycle is likely turning? Do you play through PV, two-wheeler? How?
So right now, we are not playing through all that. We are playing through auto ancillaries. And we were fortunate in being anchors in Ether, where we've added a lot later. But broadly, now we don't have the main big, although they are not bad, I would think, but we don't have, and we don't think we will have.
Okay. Samir, it's been a great conversation, and we've covered a large part of the universe. So thank you so much for coming in and speaking
Thank
with us.
you.
This has been very, very enriching on this New Year day,
Thank
and
you.
wishing you and your team a very, very happy New Year.
Happy New Year. Yes, bye.
Okay, and viewers, with that, we'll take a bit of a breather, slip into a very short break. On the other side, we'll continue talking stocks. Stay with us here on ET Now.
Back with closing trades and we're flat as ever on the index today. It has been a tempered day of trade coming in. Nonetheless, we're still above the 26,150 mark. In fact, this is exactly where we've been through the most part of the day. Although the charts might tell you a different story, we've just culminated towards this point all throughout the day. Sensex too absolutely flat. Nifty Bank continues to be where it was, a 0.2% on the Nifty Bank as well. It's eternal, the top Nifty gainer, a 2% uptick over there. NTPC, Bajaj Auto, Wipro, Shriram Finance doing well. In fact, it's a fresh high coming in for Shriram Finance yet again on the back of this 1.5% surge today. On the flip side, it's a 9% cut on ITC on the back of the newly announced excise duty that is much higher compared to where the existing excise structure is per 1,000 sticks of a cigarette. We'll get into detail about that a little later. Followed by that, you have cuts on Bajaj Finance, Dr. Reddy's, ONGC, BEL as well. But let's talk about some of the biggest news makers today. Yes, you have ITC, Godfrey Phillips that are in focus. But what about some other stocks that are in focus on the back of news flow? We have Rabinder here joining us with all of those talking points. Rabinder.
Well, as Blue Dart Express is in focus, where tax authorities has dropped the tax demand of the company from 421 crore to 65 lakhs, and the revised tax and interest amount has been voluntarily accepted and paid to avoid the protracted litigation. So, back of this slash in tax order, Blue Dart Express is in focus, and the stock is up more than 10% on the intraday basis, and now it has slipped from the 10% to 3 to 4%, but still trades in green. Shakti Pumps is also in focus on the back of the order win. Remember that in the past few days, Shakti Pumps has won several orders, and today also company has bagged order worth rupees around 67 crore from the Madhya Pradesh Urja Nigam Limited for the photovoltaic pumping system. Piccadilly Agro is also in buzzing, where company has commenced commercial production of 200 KLPD Chhattisgarh units. So back of this stock is also in focus, and the stock is up more than 11 to 12%. Oriental Rail is also in focus, where company has received railway board approval to register as a wagon leasing company, and company to offer a railway wagons on lease for the operation of Indian Railway network under the WLS. So back of this, Oriental Rail is also in focus, and the stock is up more than 2.5%. And if we talk about some of the stock that is in action on the back of their Q3 FY26 business update, first is Karur Vyasa Bank, where company has updated uploaded their Q3 FY26 business update, and in this quarter the total business stood at 2.12 lakh crore as compared to 1.82 lakh crore, which was up more than 16% year-on-year basis, and advances also showing good uptick of more than 17% year-on-year basis. So back of the strong Q3 business update, Karur Vyasa Bank is also in focus. Steel Strips is also in buzzing, where company's total sales was showing uptick of 22% year-on-year basis in the quarter gone by, and the total sales in tractor was up by 57% year-on-year basis. So back of this stock is also in focus. APL Apollo Tubes is also in focus, where in Q3 FY26, the company's sales volume saw an uptick of 11% year-on-year basis and 7% quarter-on-quarter basis at 9.17 lakh tons. So back of this stock is also in focus. And lastly, Adani Powers is also in focus, where Jefferies has maintained their buy rating with target price rupees 195. So back of this positive brokerage note, Adani Power is also in focus.
Okay, thank you so much for that, Ravinder. Also joining us, Kunal Bothra, of course, with us. Kunal, how are you looking at, and we also have Arpit Beriwal, by the way. Arpit from Motilal Oswal joining us this afternoon. Good afternoon, gentlemen. Kunal, let me start with you. What's the take like with regard to the Nifty?
Yeah, yet another flat day for the index, but I think it's good to see that there is a tinge of green throughout the day, which indices have maintained, both for the Nifty as well as for the Bank Nifty. The reason why I believe that today we're seeing some bit of selling pressure at higher levels, or maybe a resistance of sorts, is because there is some anticipatory call selling which is happening at 26,200, 26,300 strikes for the index, where there has been a slight jump in the open interest for both of these strikes. That's one of the major reasons why I would believe that the markets are trading a little bit on the softer side. But then we anticipated this in the morning that the volumes are going to be down for the indices because of the New Year effect. And I think in that sense, we may probably expect the markets to be a little bit more listless. It's only good to see that there are many individual stocks which are seeing follow through up move from the last couple of days of gain. So I think in that sense, we probably expect that the markets would regain or continue to gain up higher in terms of trends. Yes, the pace of the rally on the upside will be a little bit more slower than what we've seen earlier.
Okay, so that's the take on where the markets are headed. Arpit, hi, good afternoon. Let's talk about Blue Dart, a stock that's in focus. A very major tax easing off has been handed down to them, and that's the reason why the stock is also doing very well. In fact, in the first half of the day, we did see very healthy gains of about 7 to 8%, but Blue Dart is up over 3%. Arpit, how do some of these logistics players shape up on the charts for you? A Blue Dart, a Delivery, anything looking good?
Very good afternoon to all, and wishing you a very happy new year to
Happy
the
New Year to
entire
you as well.
team. So talking about the overall stocks, such as if we see Blue Dart particularly, today we have seen a very sharp up move. But if I look at the bigger time frame chart on the weekly scale, so it's in the process of forming double bottom pattern on the weekly time frame near 5,500 levels. It has negated the formation of lower highs after 5 to 6 weeks. So looking at the setup wise, definitely the risk reward is favorable as it is turning from its major support zone from 5,500 levels. On the upside, 5,900 and 6,400 would be a key level to watch out for. So if someone wants to play a bounce back move towards 6,400 levels positionally, it's a very good risk reward available with keeping stop loss of 5,500. The stock can head towards 6,000 and 6,300 levels positionally.
Okay, Kunal, some of the auto counters in focus as a result of those auto sales numbers that are coming through. We'll quickly give you, the viewer, a quick gist of those numbers. But Kunal, while we're at it, Tata Motors CV has seen a bit of a spike, 3% higher on the back of those numbers. How is that one looking on charts?
Yeah, limited history, Harsh,
Yes.
for the stock, but then
Yes.
given the last 1 month broadly for the stock price, the patterns have been quite consistent. In fact, we've seen the stock actually making a consistent pattern of higher highs and higher lows, even though it's on a short-term time frame. But it tells you that the demand post the demerger for Tata Motors and specifically for the CV has been a little bit more on the higher side as compared to PV. So that I believe could be an interesting aspect to look out for. And in case if this trend extrapolates itself for say the next 3 odd months, 6 odd months, then we could be looking at this as a major divergent factor between Tata Motors CV and PV, where Tata Motors CV can continue to charge a lot more better premium as compared to the PV. So I think as of now, the near-term trends for Tata Motors CV is much more on the bullish side as compared to the passenger vehicles.
Okay, so that's the take on both of the Tata Motor stocks on the charts. But Kunal, amid a market like this, where we're absolutely range bound and flat on the first trading day of the new year, where does the stock bias lie? What stocks are you liking at the point?
So I'll go with a couple of buy calls. Cummins India is something which I think is now trying to make a comeback. It's bounced off from one of the critical supports over the near-term charts. So would look out for a buy on Cummins for a near-term target of 4,600. Stop loss could be kept at 4,400. And the second is something which I've been recommending time and again over the last, I think, maybe few years. AB Capital, even at current terms of 360, it looks fairly strong. poised for a breakout on the higher side for AB Capital. Would look out for 370 as a near-term target. Stop loss at 355.
The big movers today's Snehi is some of your cigarette counters, tobacco stocks, and ITC and Godfrey Phillips are
Yes,
the two big
absolutely.
culprits. I think 10 to 15% shaved off those counters.
Yeah.
Firstly, give us the view
Yeah.
with regard to
Yes.
what's happening there, and if any brokerages have given any views.
Absolutely. So bear with me. This is very detailed. Let's talk about it and let's break it down. First of all, understand the kind of move that we've seen on these names. ITC registered the biggest ever intraday loss since March 2020. The market cap has also slid below 5 lakh crore rupees since October of 2025. So sharp fall over there, 9% lower ITC. Godfrey Phillips, it's the biggest ever intraday decline ever seen for the stock when that stock was lower by about 18 to 19%. There's been a mild recovery on that stock, but nonetheless, this has happened as and when we've started to receive more clarity from the finance ministry today. The news is, and the prima facie reason why some of these stocks are under pressure is because the government has notified that February 1st is going to be the date from which the additional excise duty will be started to be levied on tobacco products and a fresh new cess on pan masala. But let's focus on tobacco and cigarettes for now. The new cess will be over and above the GST rate of 40% that was announced in September for the entire sin goods bracket, and this new cess is going to be replacing the compensation cess which is at play right now. So to understand what changes from the 1st of February is going to be a 40% GST on cigarettes and similar products, 18% on BDs. On top of this, a health and national security cess will also be levied on pan masala, and tobacco and related products will also now attract an additional excise duty. What is this duty? What is the quantum and how is it calculated? Let's understand. Right now, the existing excise duty on these names ranges anywhere between 2,050 rupees to roughly 3,500 rupees. That's the range right now. What changes going ahead is that the amount here goes from 2,050 to 8,500 rupees, depending on the tobacco content in the cigarette, the length of the cigarette. These are going to be some important metrics to watch out for. So anything that's under 6.5 centimeters in terms of cigarette length is 2,050 rupees per share, and as and when that length of the cigarette increases, it goes all the way up to 8,500 rupees. So that's the calculation as per which the government is going to start putting this excise duty on the cigarettes right now. And like Harsh was talking about, the brokerage reaction so far we have is from Jefferies, wherein they're saying that this is a much larger than expected hike in terms of excise duty on cigarette players, and they're saying that a calculation suggests that this tax could be as high as over 30% if you put these numbers into perspective. But their most important view is that if ITC wants to be able to withstand this shocker from the government, it's going to have to at least take a price hike of 15% and then effectively pass it on to the end consumer. That is going to be an important metric to watch out for, to what extent these cigarette companies announce price hikes, because at this point it seems like it's an inevitable thing to look forward to in the future.
Okay, Kunal, on charts?
See, I think ITC at current levels, we were discussing this in the morning when the stock opened gap down by, I think, 3 or 4 percentage points, and still I maintained and avoid on ITC, because after such kind of a news flow, the stocks are bound to have some sort of an inertia effect on the downside. The concern for ITC on today's chart is the consistent selling the stock has seen throughout the trading session, which means that bounces into the stock into this kind of a pattern would be sold into. So would probably not want to look at the stock in terms of buying at current levels. Would just want to keep it on a radar as of now. Wait and watch. Maybe on the downside, I would expect 350 or sub 350 levels to be tested for ITC in the near term.
Okay, Arpit, ITC, Godfrey Phillips, what's your view there on both of these in terms of charts?
If we talk about ITC first, we have seen a sharp fall, and this has been one of the steepest fall in last couple of years. Looking at the overall setup on the monthly time frame, the stock started rallying from around 330, 335 levels in the year 2022. And now thing is sense that the next major support would be around 340, 330 levels. So from a trading perspective, it's better to wait and watch for any major reversal. However, from looking at the investment perspective, if ITC corrects towards 320, 330 levels, that would be a good entry point from a medium term 1 to 2 years perspective, with keeping major support around 320 levels. Now, if we talk about Godfrey Phillips, so overall the stock has seen a very sharp fall in last couple of weeks, and today we have seen one of the steepest fall almost falling 13 to 14%, and the stock has already corrected decent from all life high territories. Look at the setup wise for Godfrey Philip. It's better to wait and watch on the current junction, because in the weekly time frame it is forming lower as low structure, and there is no major sign of reversal. So giving the choice, better to wait and watch, avoid bottom fishing Godfrey Philip. However, for ITC, good level to entry point would be around 325 to 330 levels from a positional perspective.
Okay, so that's the take coming in on both Godfrey Phillips and ITC. On that note, we'll slip into yet another very short break and talk more about the markets on the other side. Back with closing trades. Last about 45 minutes left for the first trading session of 2026 to come to an end. But before the break, we were talking about where the stock bias lies on the technicals, at least amid a market that has been absolutely flat and range bound today. We did get some of Kunal's ideas. But Arpit, what about you? Where is the bias? In fact, where are you positive on the market right now?
If you see overall from last couple of weeks, the large caps are relatively outperforming, and we like to stick with the heavyweights bet in the large cap space. First pick would be Titan. So if you see a classical range breakout on the monthly time frame, we have seen in Titan above 3850 levels, and in last few days we have seen a good rally from 3900 to 4000 plus levels. Looking at the position setup, definitely we can see much more room upside towards 4200, 4300 positionally. So first pick would be Titan with keeping stop loss 3950 for an upside move towards 4300. Titan would be your first pick. Second would be from the another large cap space, from the capital goods space, is L&T. So L&T has been consolidating from last couple of months, almost 12 to 15 months, and finally gave a range breakout above 3900 levels. Strong reversal from the lower levels, holding well above its short-term moving averages. The stock looks good for another 4 to 5% rally from here on. So one can go long with keeping stop loss of 4050 for an upside move towards 4300 position.
Okay, all right. So that's the view coming in with regard to the picks coming in from Arpit. Let's quickly also look at some of the movers in trade today. And within the auto pack, you have quite a few movers. I'm just going to quickly pull them out. There's a steel strip wheels, which is up 8.5% on the back of the numbers. By the way, we had Tamil Nadu Mercantile Bank, the numbers also come in. Again, the numbers look strong, 16% growth on the advances front. APL Apollo is the other one, 4% higher on the back of the numbers. Ashok Leyland has done well, 3% higher on the back of numbers. Again, Karur Vysya, provisional numbers coming out for that one as well. Again, good set, double-digit growth clocked, and around 2.5% higher on that counter as well. Escorts up around 2.7 odd percent. Some of the lenders, Arpit, Tamil Nadu Mercantile Bank, Karur Vysya, are just some of the banks which are likely to be in focus today as we run to the close over the next 40 odd minutes. The view there on these two?
Outperforming, whereas we have seen the banking space, the privates are underperforming. The mid capex, the likes of Fed Bank, AU Small Finance, Karur Vyasa, City Union Bank. So particularly if you talk about Karur Vyasa Bank, the stock is in clean uptrend. It gave a monthly breakout a couple of months back, and since then we have seen a very strong rally. So another classical range breakout above 255, 260 levels, Poland flag breakout. The stock is at life high territory, forming high rise, high low structure. So from here on also, we can expect good 8 to 10% rally towards 285 to 90 levels positionally, with major support around 255. So it would be a kind of a buy and dips counter with a time frame of 1 to 2 months. Definitely the stock can head towards 285 to 300 plus levels positionally.
Okay, so that's the take on Karur Vyasa Bank. Kunal, your take on some of the big losers from the Nifty 500 group of stocks today. Something like a Deepak Fertilizers is lower by 3.5%. Now, the fertilizer pack and chemicals also overall in the last 2-3 days have been quite volatile. What is your reading on the charts?
Yeah, I think they have been volatile, but then the near to medium term charts for these stocks are still going through a recovery of sorts. We were looking at Chamal Fertilizers, for example, one of the prominent names, which has corrected almost 40% from its 2024 highs. You look at RCF, even that stock has gone through a decent correction. So it looks like that many of these fertilizer names are just about trying to pick up pace, form a near to medium term bottom for themselves, and the recovery would probably come back into these stocks. But you might not expect that these are the names which should probably be the strongest performer going into the market, where even the markets are seeing very sluggish kind of momentum, very slow, steady, gradual momentum for itself. So I think in that context, you might have to be ready for those days where one-off days the stock climbs up 3, 4, 5 percentage points, and then subsequently for the next 5 or 7 trading session, the stocks actually remain a lot more sideways, where the momentum drops down significantly. So I think that's going to be the trading style which one has to adopt for these kind of individual sectors.
Okay, so that's the take on the chemical space. Just taking a look at some sectoral moves that we're seeing today. And of course, it's auto that's done very well. We've got select auto sales numbers that have done well. It's Ashok Leyland, TVS Motors, Bajaj Auto, M&M. All of them are seeing very healthy gains. In fact, Ashok Leyland is higher by about 3%. We'll be getting Shrishti on board in a bit from now to decode all of these numbers for us. But before that, Kunal, in fact, let's get a view from Arpit. Arpit, you're reading on Ashok Leyland on the charts. Very sharp spike of 3%. Now, two questions. For someone who holds Ashok Leyland, should they continue to hold, or is this spike looking attractive to maybe book partial profit? And secondly, for someone who's willing to enter this stock right now, is looking forward to do that, is now a good level?
Been
Arpit,
uptrend
yes.
within the auto pack. It has been a huge outperformer. And look at the setup wise, the stock is seeing good rally from 140 to 185 levels. So in terms of the target wise, our first target was around 180, 85 levels that we have recommended long back also. So I think the person who's holding this position, it's better to book profits at this levels in the range of 185 to 195 levels, because that was the Poland flag target around 190, 195 levels. Second question, if someone is planning to buy fresh, it's better advisable to buy on dip counter, because overall the stock has already seen a good rally of 20-25%. So the risk reward will not be favorable at current junction. A good entry point would be around 170 to 175 band. That would be a good entry point. With keeping stop loss of 150, the stock eventually can head towards 200, 220 plus with next to 2 to 3 months time frame in mind.
Okay. And Kunal, what about Ola Electric? A 4% uptick on the back of the auto sales numbers that we have seen. A good time to look at the stock, or perhaps avoid?
I think it's an avoid,
Okay.
because there are far better names which are available in terms of solidity in terms of a portfolio. See, one-off days you might have these entertaining stocks. They would do very well for themselves. But then largely, if you're looking to play trend, if you're looking to hold stocks from long term, you need stocks which have absolute strong clarity as such in terms of the basic news flow events surrounding the stock price. You don't want to be left out with a stock where in a matter of 1 or 3 months there is a sudden news flow and the stock gets into a corrective phase very sharply. So that's one of the major reasons why I would believe that Ola right now is an event driven stock. So if it comes into the favor into the stock price, you might have one of days where the stock price moves up higher. But then if that's on the negative side, it doesn't mean that the stock consolidates, but it goes into a U-turn and the stock falls very sharply. In that context, I'll suggest an avoid on Ola. But then, if you discuss on the two-wheeler names, there are far better stocks which are available. Look at Bajaj Auto. The stock just seems to have come back into its own in terms of the breakout about 9,300, 400 mark. Hero MotoCorp, that's a stock which is looking extremely strong in terms of risk reward, placed at 5,600, 700 plus mark where it's trading right now. So, and Eicher Motors, I think that stock has been to a different orbit altogether, has been one of the prominent leaders in the auto pack two-wheelers. So, I would probably sense that there are far better names, more stronger quality stocks which are available in the two-wheeler packs, and I think that's where I would probably want to prefer.
Okay, so that's an interesting take coming in on how to avoid Ola Electric on the charts, but rather focus on names like Bajaj Auto and some other two-wheeler names in the market right now. But on that note, time for another very short break. We'll be right back to track the last lap of the market on the other side.
Welcome back and thanks for being with us. Mayuresh Joshi joining us, Head Equity at MarketSmith India. Mayuresh, firstly wishing you a very, very happy 2026. What are you buying?
Afternoon, Harsh. Wishing you, the entire team at ET Now and all your viewers a very healthy, peaceful, and a prosperous 2026. So largely, I think after the performance of the broader markets, which have been a tad bit disappointing for 2025, our take is the markets might actually show a rebound based on the earnings trajectory that a large part of the markets might actually start recouping in the next few quarters. Q2 has been relatively resilient, and therefore Q3 numbers will be keenly watched out for. Apparent signs of turnaround if seen in Q3 and the second half would lay base for a 12 to 14% consensus earnings growth, which is getting played out uh, by most analysts exit 27. And therefore, I think select sectors, select stocks might actually continue doing well. So some of the themes which are probably looking on our sector rotation graph at Pandre at Markets with India, the software that we closely track, a lot of thematic indices. Consumer discretionary is coming back very, very strongly. Select BFSI is looking durable in terms of earnings recovery and a few infra stocks. So I think a few stocks which are trading close to the pivot levels as we speak in Markets with India's model portfolio includes the likes of Vishal Megamart as an example, which is a proxy to consumer discretionary house. Our own sense is that based on Q2 numbers, where EBITDA margin in the first half have shown a significant amount of improvement to 9.4, 9.5%. Sales have shown a 12% increase. Our take is with consumption expected to come back strongly, specifically post the GST rationalization moves, and the kind of mix that Vishal Megamart has in terms of apparel, FMCG, other FMCG as well. I think that looks strongly placed. Financials, I think we've always been propagating Shriram Finance from the NBFC universe, and a disclaimer, we hold this stock in our global portfolios. But PSU Bank selectively might still continue doing well. Bank of Maharashtra becomes an example which we hold in our domestic and global portfolios as well. Our sense is that the cost to income ratios are dwindling lower. Asset quality pressures are dwindling lower every passing quarter. Provisioning is well provided for with the PCR standing at 98 odd percent. We're probably looking at tier 1 ratios which are very, very strong at 14%, which makes us believe that if the run rate probably continues in terms of earnings delivery, the expectations that you probably have in terms of better ROAs, ROEs should continue. Auto Angs as a space should selectively continue doing well. And within that, Uno Minda is something that continue liking in terms of ratings and rankings that we've got in Markets with India. Integrated facilities, content per car expected to go threefold over the next few years. They've got platforms that are adopting and creating platforms which are EV agnostic as well. So I think it's a good mix in terms of ICE engines that it provides at this current juncture, and EV platforms and systems going forward as well, with the content per car might actually double or triple over the next few quarters and years. So Uno Minda is something that we continue liking. So selective on a few sectors which are looking good as per our thematic sector rotation.
Sounds good over there, Mayuresh. Good afternoon and happy new year to you. Let's shift focus rather from there and talk about the auto sales numbers that we've seen. Some very good numbers so far, and some of the stocks are also reacting because it is the beginning of another new year and a brand new month. And of course, it's time for the auto sales numbers because it is the first of the month. So let's understand how has Motown fared in the month of December. Shrishti is here to give us a lowdown on that. Shrishti.
Well, yes, December month has been quite robust for the auto sales industry. Not just it was the period wherein the discounts were on the higher side, but believe so that after that GST bonanza, there has been no stopping on the sales front. And for December 2025 as well, that's exactly what we have seen. And we have been telling our viewers that this time around, for all the segments, do expect a double-digit growth. And the companies have also delivered very well so far, because most of the companies have either reported an inline set or some of the companies have managed to surprise us as well with the numbers better than estimates. On your screen, you can see names like Eicher Motors VECV, M&M Automotive Division, Maruti, and even Escorts and Tata Motors commercial vehicles were some of the numbers that were very good as per versus the estimates. So let's deep dive into the numbers. And firstly, let's start with the passenger vehicle space. Herein we have seen Maruti Suzuki numbers were very strong at around 2.2 lakhs of units. Tata Motors were did very well with a 14% jump on a YY basis, while for M&M as well, for their automotive division, it's a 23% jump is what the company has reported. Other than that, within the commercial vehicle space, that's where the latest excitement is, because do remember that post that GST bonanza, the consumption did pick from the leading spaces within the retailer basket. Be it the two-wheelers, be it the cars, but now the commercial vehicle segment is seeing very good demand, and that's reflected on the numbers as well. Look at the number for Eicher Motors VECV, 10,384 units is what the company has reported, and that's a jump of 36% on a month-on-month basis. When it comes to Tata Motors CV division, 20% growth on a month-on-month basis is what the company has registered, and not just that, they're saying that the sales momentum is expected to continue for majorly all the segments across the CV. And for Ashok Leyland as well, very strong growth of 20% is what they have reported. Within the two-wheeler pack, look at the number for Eicher Motors Royal Enfield. Reporting a number over and above 1 lakh is becoming quite a norm for Eicher Motors Royal Enfield, and that's once again is what the company has delivered, and they believe so that the demand and 2026 is looking more interesting. And lastly, from the tractor division, seasonally, December is not that strong for the tractor industry, but this time around, because of good sowing season, healthy rainfall, and more income in the hands of the people, even the tractor space did so very well. It's a 38 to 39% growth on a YY basis is what Escorts and M&M have reported, and they believe that the next coming months also is going to be interesting. So all across the board, very good set of numbers coming in from the auto sales. Back to you.
Okay, Shrishti, thanks so much for taking us through that. Yes, some very good performances coming in this time around, and like Shrishti was mentioning, either in line or much better than expected performances what we've seen. Kunal, your take on some of the four-wheeler names. We didn't speak about the two-wheeler names, but what about something like a Maruti Suzuki versus an M&M? Does this change the way how those two stack up on the charts against each other?
Well, absolutely, yes. In fact, I would probably believe that Maruti is a far more stronger stock right now as compared to M&M, purely in terms of relative strength. The way the stock has managed to move in the last 3-4 months, specifically from the August point. Maruti was a stock which was at 1100, 11,000, and from 11,000, 11,500 levels, the stock has already given 50% kind of returns in this kind of a time span. Now we try and compare this with the likes of M&M in the last 4-5 months. That stock, even though yes, M&M has given positive returns on the higher side of, I think, the tune of 15% odd, but then it's far underperformed the immediate peer Maruti in that sense. More importantly, when we look at the charts, the tendency of the stock price to go into a correction and then to try and make a bounce back, Maruti has scored very very well in that degree also. So that, I believe, is a very strong quality and feature for a stock price for Maruti. Would be bullish on the stock in the near term and expecting the stock to be one of the stronger leaders emerging from the entire auto pack.
Okay, so that looks good, and that's the take on some of the four-wheeler names. Just shifting focus, and let's talk about some of the stocks that have done well other than the newsmakers today, purely on the back of volumes or some other news flow. You have PNB Housing that's up about 4%, looking very good over there, as is the case with the JSW Energy up 4%. Arpit, your take on some of these names on the charts, and how are names like these shaping up?
If we first talk about PNB Housing, so the stock has definitely seen a good recovery from the lower levels. The stock has almost seen a rally from 820 to almost 950 levels in last couple of weeks time frame. So with the setup wise, definitely the stock can head towards 1040, 1050 levels, as this the entire space is in flavor with major support around 950. The stock can head towards 1040, 1060 levels. Now talk about JSW Steel. So definitely the metal pack has been an outperformer from last couple of weeks, and we have seen a tremendous rally in the metal stocks. Particularly JSW Steel has just joined the party last couple of days back. And if you look at the setup wise, the stock has formed a strong base near 1120 levels. Yesterday we've seen a gap up opening. Today we have seen follow up buying. And definitely looking at the overall metal index, the index is likely to outperform, and stock being the huge large cap within this space. So I think the stock can head back to its previous all-time high around 1220, 1250 levels. And positionally also the stock can head towards 1300 plus levels. So JSW Steel, the chart wise is quite strong with support around 1120 for an upside move towards 1240, and then positionally 1300 plus zones.
Okay, so that's on PNB Housing and JSW Steel on the charts and how they're shaping up. But let's shift focus. And in its financial stability report, the Reserve Bank of India has flagged rising insurance commissions as an emerging stress area. The RBI says commission growth is outpacing other costs, especially at private and life insurers, warning that aggressive commission-led growth could weaken underwriting discipline. My colleague Anurag Shah is here with the highlights of what the RBI is flagging off when it comes to the insurance space. Anurag.
Interesting observation by Reserve Bank of India's FSR report related to insurance distribution cost and insurance commission structure. So RBI has flagged that rising insurance commission as an emerging stress area. In FSR report, RBI has mentioned, and private insurers sees sharp rise in commission payout. Other than that, premium growth is increasingly driven by high cost distribution strategy. So that has been pointed out by RBI's FSR report. Rising commission could weaken the underwriting discipline, that is also mentioned in FSR report. Non-life insurers, general insurance companies and health insurance companies also see escalation in commission expenses. So we have seen that in the recent Insurance Act Amendment Bill, Sabka Bima Sabki Raksha, IRDA is more empowered to decide on commission reward and other expenses. So in RBI's FSR report also, RBI has found and made remarks that insurance companies are increasingly focusing on high distribution costs to acquire business.
Okay, thank you so much for that, Anurag. Mayuresh, if I can again shift focus back to auto. You suggested that you're playing auto likely through Uno Minda, and that's probably one way of playing it. Auto Ank. Is there a particular tilt you have in terms of a preference, PV, CV, two-wheeler, and Uno Minda? Any specific reason why? Could you give us the gist?
Harsh, I think the new plant is probably opening up for them. So they've already got integrated facilities that they are carrying on. The EV penetration for four-wheelers has touched 5% for the industry as a whole. 9% for two-wheelers. They've crossed the 1 million mark in FY25. So it should be relatively higher going forward. And therefore, I think the kind of components or content that Uno Minda is probably making at this juncture, whether it's airbags, whether it's seating, acoustics, lighting, I think they are all products which will probably go into the EV ecosystem, specifically when it comes to two-wheelers or four-wheelers in particular. And therefore, I think as this ecosystem develops, I think they have got ready products in terms of the EV value chain. And therefore, I think they will be future ready with the products that they've probably got. Let's not forget, as I mentioned in my remarks, that the ICE products will still continue. And therefore, I think a large part of their basket with the modifications that they're probably doing and the tilt towards the EV ecosystem, the content per car generally as a benchmark should go up 3 times. So I think around 12 to 15,000 per car. It should probably move up in the higher range of 35 to 40 or thousand. Even if it doubles, as an example, Harsh, on a base case scenario over the next year and a half or 2 years, you'll see a significant jump happening in terms of the top line number. And with integrated facilities, the margin should show gradual uptick. So I think that's the operating leverage we're trying to play through in terms of a few auto anchors.
Okay, so auto anchors are looking good. Talk to us about what is the view on some of the tire stocks because Mayuresh, the auto sales numbers have looked very good. So I'm assuming the quarter gone by for the tire stocks could have also done well because we've seen a good move coming in on someone like an Apollo Tyres, Seat. What is your take on how that quarter gone by could have shaped up for some of the tire names?
So again, 2 things. One, I think in terms of the OEMs doing well will probably mean that the tire companies will also probably do well. And tire companies will do well on both counts. With OEM expected to be faring relatively better in terms of the sales numbers and the volumes that they are exhibiting. I think that is one clear indicator where their sales sustainability should continue. On the other hand, the replacement market, which has been a key market for tire companies, and where pricing probably remains largely in their favor with better margins, I think that remains relatively strong as well. Now, if you combine these two factors put together and you probably look at the entire ecosystem, whether it's PVs, two-wheelers, and where CVs were probably lagging. The CV ecosystem is now picking up, whether you're talking about MHCVs or LCVs as a last mile advantage. And therefore, with CVs picking up, I think the entire gamut that tire companies probably have to present themselves continue on a strong footing. At the same time, input costs have remained relatively benign, and that aids them significantly in terms of margins going forward. To break up the tire stocks, I think something like a JK Tire and an Apollo Tire seem to have very strong ratings and rankings as we've seen in markets like India. Again, a large part of their portion in terms of the revenue mix comes in from the replacement market. For JK Tire, again, a large part of their product mix comes through the CV players itself, followed by the PV ecosystem and the two-wheelers. And obviously, I think they've got a play in terms of both the OEM and the replacement market. For Apollo Tires, again, I think they've got an international operation in place, which should do relatively better as we head into the next 2 years. And therefore, these factors can be enablers in terms of earnings remain relatively stronger. So I think anybody holding a stock like JK Apollo and the innovations that they're probably doing in terms of the EV ecosystem as well, introducing those tires, green tires as well, I think all that might actually work in favor of them as we head into Q3 and the numbers there.
The other big buzzer today is Ajanta Pharma, and it's done ever so well. In fact, if I pull up the 1 month chart as well, it's likely done very, very well for itself. Arpit, do you have a view with regard to this one?
If you see overall, the pharma space has been relatively in a sluggish to consolidated way, but selective pockets are still outperforming. So if you look at the chart structure of Ajanta Pharma, after a very long time, it has given a consolidation break on the weekly scale after almost 3 to 4 months with good volumes, a strong bullish candle. So I think definitely the stock can have seen some more room towards 3,000, 3,100 levels. So with the setup wise, definitely the stock can head towards 3,000, 3,100 levels with major support around 2,850. The stock can head towards 3,100 positionally in next couple of weeks time.
You give us a view with regard. Okay, firstly, Arpit, thank you so much. We'll let you go on that note. I hope you have a very, very happy and prosperous 2026. So let me first close that conversation out. Okay, Kunal, let's come to you with regard to a Blue Dart. Now, plenty of movement on that stock chart of Blue Dart for today. Give us your take with regard to some of the other logistics players and anything that you like within that space.
Yeah, I think the few names which I do recollect from that particular space, other than Blue Dart, has been Aegis Logistics. That's a stock which I think on the long term basis has been doing reasonably well. Blue Dart specifically after today's news flow, I was actually looking at the longer term charts for Blue Dart, and I think over the last 1 year, the stock has seen a major correction of sorts. We've actually seen the stock falling very sharply in the first half of 2025. And then for the last 4-5 months, we actually saw the stock going into a consolidation as such. Now, what this move for Blue Dart could do is this: it could end this phase of consolidation for the stock price. We've generally seen that stock price, they generally tend to bottom out a phase of consolidation when there is some sort of an event or news flow driven to the stock. For Blue Dart, that event has played out today, and I think that would be one of the key reasons why I would believe from a positional play the stock would start to look attractive. The only catch with stock like Blue Dart is in many phases when the stock goes into a correction or sideways, the volume drops down significantly, so it tends to become a little bit more illiquid in terms of the key parameters and volumes.
Okay, so that's the take on Blue Dart and Aegis Logistics that Kunal is liking at the moment on the charts. Mayuresh, what is your take on the Alcobev space? Today, some of the top FMCG losers are United Spirits, almost a 3% cut over there. UBL, Radico are also seeing some profit taking today. What is your sense on this entire sector, and which stocks would you like from this basket?
No, so I think we owned Radico, but as a clear disclaimer, I think we booked out just a few days back. Had a good run and a good return out of that stock. Our sense is that the kind of volume growth that you're probably seeing is penciling in the kind of entire premiumization story that we now see. Now, they've already reached a peak premiumization level. Now, to expect them to probably have premiumization levels to go up far higher from the current levels, they'll need to maintain that mix, is our opinion. I think between the premium products and the go-to market or the economy products, because I think that is where a large part of their overall volume sales comes from, where premium will give them better margins. However, I think as a mix of both of them, I think almost the peak capacity or the peak percentage in terms of premium is there. It might be another 400, 500 odd bips that might actually happen over the next few years that introduce more products. like a United Spirits or Vladimir Khildan. So they are good stories at the end of the day. But somewhere our sense is that the entire premiumization story might get capped off in terms of the percentage contribution to revenues. And if that probably happens, if one really expects margins to multiply from the current levels, that probably seems a little bit circumspect. So our own sense is that good stories, input costs have also gone lower. Molasses, glass prices are benign as we speak. But if this gets capped off, I think the valuation cap off will probably happen. Then the re-rating will come through better numbers delivery, which in our opinion might take some amount of time.
Kunal, what do you make of the move on transformers and rectifiers India? I don't know if you track the stock closely, but from the bottom it's up nearly 5%. And the move looks quite solid. So trying to get a sense as to how you're seeing this on charts.
Harsh, I don't track it, so I'll skip this one.
Okay.
Apologies.
Mayuresh, with regard to the power space and the power ancillary space, would you play through the transformers?
I think a large part of the move, Harsh, has happened. I think look at the
Right.
stellar move in terms of price action, right? And the valuations have probably peaked off. Again, I think in terms of core numbers, I think the market itself, the transmission market is expected to double or triple from the current level with expansion happening in renewable capacities, thermal capacities getting added as well. And therefore, there is a huge amount of outlay that is going to happen towards these sectors as well. Transformers will be the need of the hour. So ultimately, I think there is going to be growth happening here. But somewhere I think there is some element of discomfort that probably happens in terms of risk reward. One stock that we are probably watching out for is Power Mech, because I think it's a good combination in terms of how they're servicing the entire EPC ecosystem as far as power is concerned, as well as the O&M contracts that they probably win. So I think if they win through a large part of the O&M contracts, I think the kind of servicing contracts also comes along with the package that they probably get. And therefore, I think earnings delivery expected to be relatively better. If one really builds up this entire power narrative, which is expected to happen and is going to happen, I think Power Mech is one stock that might do well. But yes, Transformers as a theme will continue posting reasonable numbers, but there is a valuation discount.
Okay, and Mayuresh, what is your take on ITC in particular today, the kind of drawback that we've seen on that stock right now, about 9% lower? Does it make for a good case to now perhaps buy that stock for someone who's been waiting for a good point to enter, purely on the fundamentals, given that we have so much happening on that excise duty front today? Would you be a buyer in this stock?
No, I think we've maintained a neutral view for a long periodicity of time. I think the kind of cuts that you're seeing on the stock because of the excise duty, I think ultimately at the end of the day, let's see how numbers will play out, because the cigarette market is a highly demand inelastic market. And therefore, I think if the numbers go down on an absolute basis because of the price increases, it probably gets compensated. To a large extent, we've seen this in the past as well, that it does not create a major dent in terms of cigarette volumes. Obviously, I think cigarette cash flows are the cash cows as far as ITC is concerned. But my other concern for ITC is that they are probably investing a large part of their cash flows into newer businesses. And as this transition happens, as we've seen in the past, when ITC was foraying into the other FMCG business, you will see longer periodicities of numbers delivery, which will remain a little bit stagnant. And therefore, my own sense is that this stock might actually consolidate for both these reasons put together. The first reason, the markets will take it in its stride. The second reason, reinvestment in other products, other categories, will mean some element of ROC deterioration, which might just play out negatively in terms of reported numbers.
Okay, let's switch focus. Gig workers strike, it had very, very low or negligible impact on companies according to sources. Zepto and others claim that operations remain normal. Anjali joins in with all of the details that she's been picking up. Anjali.
Right, so the gig workers union had called for a nationwide strike yesterday on New Year's Day and the eve, given the harsh working conditions, asked with a big list of demands. But what we're picking up from sources within the company and the industry is that there was very negligible impact of this strike, and this is largely due to the low participation from the gig workers in this strike. Now, industry sources say that because of this, the impact on companies has been negligible. In fact, a source from Zepto has confirmed that there was only impact seen only in a few pockets in the metro cities, especially Mumbai, and other than that, the operations remain normal throughout the country. Now, we also spoke to a few gig workers who were working through the evening to understand their motivations for not participating in the strike, and a lot of them said that it was because of the lower overall participation for the strike throughout the entire gig working community. Now, however, the union leaders claim that over 60% of the orders were impacted, and over 2 lakh gig workers have participated in this strike yesterday. And they've also said that Hyderabad, Bangalore, Kolkata, Delhi and Rajasthan were the most impacted. Now, remember, yesterday, to incentivize these gig workers to work on New Year's Eve, more offers were rolled out by companies. In fact, Swiggy and Zomato both had come out with letters sent to the gig workers assuring them of their safety during deliveries, and this might have aided the participation from the gig workers as well. But the unions have slammed these, saying that these additional incentives is corporate propaganda, and that the companies have come in the way of a very peaceful protest. So yeah, we have the union leaders and the companies locking horns over this issue, but largely yesterday's strike did not have any impact, any material impact on the company's operations.
Okay, Anjali, thanks so much for taking us through that. So yes, no major impact. And in fact, when we interacted with the union head on December 25th also, which was the first day of this strike, we also understood that there is not much impact happening. And this is what our conversation with companies also yielded. But Mayuresh, quick take on some of the quick commerce, quick food delivery players. Eternal is doing very well today. Swiggy is also has been doing decently well for itself. But yes, it's been seen a little bit of a consolidation. But now that Zepto is going to be listing this year, or perhaps they filed that confidential IPO, what is your take on how the quick commerce space could pan out once there's a third listed player there?
So obviously, that's playing on the price. That's one. Second, I think in terms of the expansionary mode that they started a couple of quarters back, 3 quarters to be precise, in terms of their dark store expansions, that obviously had a implied effect in terms of margins, specifically in terms of their food delivery business as well as the quick commerce business as well. And therefore, I think the expectations in terms of volumes remaining stronger for the industry as a whole will continue. I think there is a huge incremental demand that has now seeped in, specifically in the urban mindset, which probably means that the volumes will continue. It's about the margin profile and the bottom line growth, which ultimately will drive numbers and the EPS ratings and rankings as we see it. Obviously, I think what we are hearing in terms of the unlisted players as well, what Amazon is expected to launch, what DMart is doing in select circles, or what Reliance Retail might do, and how they will pack up their entire ecosystem with a huge players, with huge players like Amazon and Reliance Retail, if they do decide to enter. I think then that will have a very interesting take in terms of how pricing for the industry will play out. So our own sense is that it's a wait and watch. Q3 numbers will be very, very interesting for both Eternal and Swiggy.
Okay, on charts, Kunal?
Yeah, I believe both these stocks, Eternal as well as Swiggy, they look fairly attractive to me on the charts. In fact, I've been making this point last day or a couple of days back also, that 275-ish kind of a zone for Eternal, I think is a good zone where the stock could see a bounce back. The indicators, Harsh, after this 20-odd% correction for Eternal, I think has come back into a deep oversold territory for the stock, and you're bound to see a bounce back over here. My expectation is that from a near-term angle, I would look at 295 to 300-ish kind of a target for Eternal. That's why I would believe that short-term players may try to book some bit of profits over here in case if players probably have bought the stock at lower levels.
Okay, Kunal, Mayuresh, thank you so much for joining us this afternoon. We'll let you go on that note. And it's Ashesha with the market wrap on 1st January 2026. Ashesha, how was the market? Sum it up for us.
Well, yes, we've barely seen any action on the index level. Nifty ending absolutely flat for the day near that 26,140 mark. Clearly, we've not seen any action on the first day of this calendar year. Nifty Bank, that one is ending 125 points higher, 0.2% higher for the Nifty Bank to end near that 59,000 mark. Of course, we are just 300 points away from that 60,000 mark. But yes, ending 125 points higher. Broader market indices should also come up for you on your screens. Nifty may
mid and small cap index. That should come up for you on your screens because mid cap index is ending the day with an increase of 0.5%, while Nifty small cap index, that one is ending absolutely flat for today's trading session. In terms of individual stocks that were bucking the trend, let's put the spotlight on Eternal or Zomato. That one was gaining all through today's trading session. So Eternal, that one is ending with an increase of nearly 2% for the day. Something like M&M from the auto pack. Remember, we had auto sales data that came in for the month of December. The entire auto basket was in top gear today. M&M up in excess of 1%. Something like Bajaj Auto, Eicher Motors should also come up for you on your screens. We have seen quite a bit of action over there as well. But remember, cigarette stocks and tobacco stocks were under pressure today on account of that government notification that came in, which suggests that these companies might have to undertake price hikes to the tune of 15 to 20%. ITC ending the day with a decline of 9.5%. Godfrey Phillips down 17% for the day, and VST Industries, that one was also declining in trade, ending the day with a decline of nearly 1%. This, of course, outperformed as compared to other cigarette players. In terms of other newsmakers, Vodafone Idea, remember the stock tanked in trade yesterday, but we have seen quite a bit of recovery in trade today, ending 8% higher, and Indus Towers with Vodafone Idea was also surging nearly 4.5% in trade today. So yes, a whole host of buzzers from the broader markets, but on the index level, we've barely seen any action on the first day of this calendar year. Nifty ending above that 26,100 mark. Nifty Bank, although, was outperforming in trade. But that's all the time we have on this edition of the show. Thanks so much for tuning in. More news and updates will continue on the other side.
in association with SBI.